Okay, so over to Paul. Good morning.
Good morning. Now I'm going to try and get some technology to work for us. Is that working, Marie?
Yes.
Do you see the white screen?
Yes.
Great. Good morning, everybody. The reason we're here is because insurance is a problem for the industry, the cold chain industry. It's been significantly impacted by reduced insurer appetite and increased premiums year on year, particularly over the last 5 years. As an industry, it's time to consider an alternative to traditional insurance, where this alternative provides protection like insurance. Is anybody getting feedback?
No, you are?
Yeah, that's okay, then that's fine. So this alternative to traditional insurance is called a discretionary mutual fund. I thought I'd give you the topics that can be covered by this presentation so that you can understand the flow and you can potentially hold questions off until we've got to the end, because I might cover everything. So the topics we're going to cover is about us, and there are 2 entities that I'm going to talk about. What is a discretionary mutual fund, how a discretionary mutual fund operates, how it's different to traditional insurance, financial benefits of the discretionary mutual fund, partnering with Benjamin and Steadfast to create and manage the discretionary mutual fund for you are the topics I'm going to cover today for you. So about us. My name's Paul Benjamin. For those of you who haven't met me, I own Benjamin Insurance Brokers. It's a 3rd generation insurance brokerage that's been owned by Benjamins. My grandfather, Oswald Benjamin, opened his business in 1921 here in Melbourne, which was the first Lloyd's brokerage in Australia, in Melbourne. We don't try to be all things to all people. We're a boutique insurance brokerage. We have over 8,000 clients, and we've gathered most of those by working with many associations like the RWTA. And the reason that we're engaged by our clients is we help them solve problems. ANZIF stands for the Australian New Zealand Institute for Insurance and Finance. So I wear 2 hats in the industry. One is as owner of Benjamin Insurance Brokers, and the other one is chairman of the Insurance Broker Board at that peak body. So I'm excited to work with the RWTA members and any of the brokers they happen to want to work through as well. So just understand, I wear 2 hats. My objective and my team's objective is always to make sure people have got the right insurance at the right premium, no more, no less. On the right-hand side of the slide, you can see there's a logo at the top called Steadfast Art, Alternative Risk Transfer. Let me talk to you about who Steadfast are. Steadfast Limited is the largest general insurance broker network in Australia. My business is part of the brokerages that's part of that network. We deliver about $13 billion in premiums in Australia. That's half the business premiums paid in Australia. And Steadfast is listed on the stock exchange as top 200 company and currently has a market cap of $5.8 billion. There's a division at Steadfast called Alternative Risk Transfer, and they work with businesses like mine to provide solutions for industries like yours. So that's why you'll see both the logos in this presentation. It's my business working with Steadfast Art to provide you with a solution. But let's get in. For those of you who want to know a little bit more about my business, here's a very quick a 50-second video to talk a little bit about what we do and how we do it.
There's no audio with this that I can hear.
There's no
Paul.
audio. Okay, then I'm going to stop that. Thank you for letting me know. I thought that would come across. That's okay. We'll move on. That's
Sorry
probably
about that.
saved you all a lot. So let me talk about a discretionary mutual fund. I've got to tell you, it's a really fascinating video. Anyway, a discretionary mutual fund, the acronym is a DMF, and you'll see that acronym throughout this slide presentation. This presentation is quite detailed. I'm going to get through about 14 slides, which covers off a whole range of things. We are recording it, so you can review that if you need to, and I'm always happy to come out and talk with you, and through a process that Marianne will deploy over the next couple of weeks. I'm always happy to engage to give you information that you may not have picked up through this presentation. So a DMF is based on membership. For it to be successful, most industry members need to be in the DMF. And the membership needs to be exclusive. And at the national conference, we talked very quickly about the fact that if people aren't members of the RWTA, then they would pay a higher premium to be part of the DMF, because if you're a member of the RWTA and a member of this, then you'll get a financial benefit that they won't get. Membership is based upon a whole risk solution, meaning that each new member into the DMF will have a full risk review that covers property and liability. And from that, there'll be alternatives available through the DMF should the member decide they want that. The mutual is a membership for like-minded firms who value risk management and risk prevention, and you pull together to promote best practices amongst you and your peers. And it's through this that you will get financial benefit in the premium that you pay, because the intention is to reduce potential claims. Typically, the more members a DMF has, if that's big and small, the more successful it is, as the risks the DMF assumes are spread more broadly across them. The basic principle of insurance is a premium pool. The more people you have in the premium pool, the bigger the premium pool, the lower the premium is per risk. And if we look at how car insurance operates, car insurance, somebody might own a $100,000 car, and they're going to pay, I don't know, maybe $2,000 for that. If they were just trying to self-insure that themselves, they've got to carry $200,000. Or if there were only 10 people in an insurance company covering that, then clearly the risk to cover $100,000 is going to be far greater than the $2,000 they pay. So the greater the pool, the lower the premium. And a DMF is a long-term proposition to access the full benefits. You really need to be looking at this as a 5 to 10 year investment plan. It's not about getting good premium this year, pulling out of the DMF next year and trying to get into the standard insurance market, because it's about managing the financial flow of money through the DMF. If people keep on chopping and changing out of the DMF, then there's not a stable premium pool, and that has an adverse effect on the money you pay per annum to protect your assets. So a discretionary mutual fund is typically a company that's formed and owned by the members of the industry group. In effect, the DMF provides insurance in whole or in part for members' business insurance program. So you might just take one type of policy out of it, or you might take a few. So that's what that means. And each member contributes an annual contribution to the fund. Because it's a fund, it's not an insurance company, the money you pay per annum is not called premium, it's called a contribution. And in return, the DMF assumes a liability for the specific risks that you've paid that contribution for. All annual contributions create the aggregate total pool of monies, total pool out of which claims are paid, and expenses to run the DMF are paid. That's the maximum exposure you can have in a DMF. You can't pay out more than you've received in funds. Now, if claims happen to exceed the total amount that you've received in that contribution pool, That's where the DMF needs to take out what we call an excess of loss insurance from an insurance company. So let's say the total pool is $5 million that's created by the DMF. And in the year, there might be $7 million worth of claims. Out of the pool of $5 million, you're going to deduct money for running the DMF, and then that's going to leave a balance. Let's call that $4.5 million. If there was $8 million worth of claims, then this reinsurance or excess of loss insurance will pick up the balance. So the DMF is protected so it doesn't lose money, and that it protects the continuity of the DMF from running. So the structure of a DMF is this. There are members of the DMF, clearly. There are a board of directors, typically made up of the members of the DMF. Insurance policies are actually not issued because it's not an insurance company. Rather, they're called risk protection agreements. Because it's not an insurance company, it can't issue a policy, but it can issue these things called risk protection agreements. And what happens by that, by setting up a DMF, is that you're now not controlled by the Insurance Contracts Act, but you are managed as a DMF by ASIC. So there is security for the members in the way it operates, and there is security in the structure of how it operates. The term discretionary is used because the board of directors, acting in the best interests of the DMF, decide whether or not to pay a claim. Therefore, the decisions are termed to be discretionary. In practice, seldom is a claim ever denied, because you've got excessive loss insurance to protect you if you exceed your premium pool, or sorry, your contribution pool, sorry. And because it's a DMF set up by the industry to support members, the DMF is inclined to want to support the members by paying claims. But it's not regulated under the Insurance Contracts Act, and therefore there are no obligations that have to be met and penalties that could be imposed on the DMF that can be on an insurance company if it doesn't happen to operate in the best interests of the policyholder, or we'll call it the risk protection agreement holder. The DMF also decides how any surplus monies that hasn't been paid out in claims will be used. Typically, it's reinvested to help members, risk improvement programs, or contributions for future claims kept on hold, on deposit, generating income until they might be needed for future years. But those decisions are made by the board of directors. Now, risk management is essential to the success of the DMF. And I'm going to give you 4 considerations of the operation of the DMF so you understand how it works. So the first one is it's highly risk managed. And although the board of directors are the directors, they're not responsible for doing all this risk management. Through Steadfast Art, they will provide this whole structure and strategy and implementation. So that it's really important the DMF has a high level of risk management, because ultimately its purpose is to reduce claims. You, as a policyholder under an insurance policy or through a risk protection agreement, you just don't want to claim. I mean, the worst thing that can happen to you is if there's a major fire at your premises and you are out of business for 6 months, a year, 2 years, 5 years, whatever it is. That is a terrible impost on you and your lives and those of your employees and all your suppliers and customers. So the intention of the DMS is to help you be better risk managed. Consideration of the operation of the DMF is that it's exclusive management, exclusive membership. And these risk reviews are there for prospective members so that they can, if they join, they get the benefits. DMFs are specific to industry groups, and they're becoming more popular because insurance is getting more expensive year on year. The intention of the DMF is to help drive down claims. An insurance company will just pay out if you have a claim. The important piece here is a DMF is there to help you drive down potential claims. And as I said earlier, it's a long-term commitment. Members need to think about being a member of it for 5 to 10 years to make it financially viable. Now, how does a DMF differ to traditional insurance? So traditional insurance policies are based this way. An insurance company agrees to take on the risk of a policyholder in exchange for the payment of insurance premiums. The insurance company is obliged that valid claims made under the policy will be paid. They're obliged. Insurance companies price their premiums to make profits. This is a really important difference. They're out to make profits. All the major insurance companies that operate in Australia and across the globe are listed on the stock exchange, on their respective stock exchange. They're there to provide shareholder returns. They're there to make profits. If a policyholder makes a claim, it's likely their insurance premium will increase the following year, and in fact, following years. And as we all know, insurance premiums can and do go up even if you haven't made a claim. The last 5 years have been incredibly tough on everybody. The difference with the discretionary mutual fund is there are no shareholders to generate profit for. The DMF is not profit driven. It's a not-for-profit entity. So they're not pricing in profits into the cost per annum. The DMF has a capped exposure to claims on its contribution pool, and reinsurance take care of the total losses that exceed that. Any surplus is reinvested to help the members and offset future claims. All members have the right to have their claims considered, but the board of the DMF has discretion as to whether they will or won't pay claims. And as I said before, seldom is a claim not paid, because your directors are your members and they're members of your industry. So the cold chain has been significantly impacted because of insurer reduced appetite and premium increases. So it presents the opportunity for you to consider the formation of a discretionary mutual fund. Because it's likely that we're going to be able to drive down your premiums, there's cost management. It helps you reduce your costs of your business by reducing the cost of insurance. That's one of the important things to know. The second thing is, because it's not an insurance product, it doesn't come with the standard insurance costs. If you're in New South Wales, you pay a huge fire services levy, not applicable. State taxes of stamp duty don't apply. GST will apply, but these other items and other charges that might be charged by the state government won't apply, because this is not an insurance product. Great, huge benefits for you. It's a fit-for-purpose product because it's specific to your industry. The risk management, the analysis of the risks are specific to your industries, and the product is priced specifically for you, not part of a basket of a multitude of industries and multitude of properties and liabilities. It's specific to the cold chain industry. And because it's a collective risk, reinvestment of surplus funds helps manage the collective risks to help reduce potential losses in the future through great risk management. These are the important things, the opportunity the formation of the DMF provides to you. I talked earlier about steadfast alternative risk transfer. I'm going to just take you through how they fit into this picture of helping create the DMF. This is a pretty busy chart, and I'll just quickly take you through it. They help to establish the context, they identify the risks, and they analyse and evaluate the risk, and they help treat and manage the risk. The great thing for you to know is that Steadfast have received ASIC endorsement and approval to form DMFs. They've done this many times before. They understand the process, they understand the need, and they have in-depth knowledge of this to help walk through this process. This is not a first time, oh, how do we do this? They're there to help us make this work. Their management is responsible for the operation of the mutual. So I said there was a board of directors made up of members of the mutual, but Steadfast Art will help run the mutual. So they're the conduit between the DMF, me, your members, claims management, risk management, and reinsurers. If I go to the next slide, you'll see that they have here, Steadfast have their own in-house claim solution that they provide as a solution for to DMFs. They've got experience. The claim service is tailored and bespoke, and they have strong industry partners to help work through issues of assessment, rebuild, engineers, working with councils, if it comes to liability claims, working with law firms. They have a breadth of experience across Australia and many years of it. They also provide the excess of loss facility that the DMF will need by working with reinsurance companies to get the right product at the right price. So the steps that are involved to assess, form, and arrange a mutual are these steps. Now, it's a busy slide. I apologise for that, but these are the steps. So there's the initial assessment for the suitability to form a mutual. And that was the information that was sent out by Marianne in an email out to everybody for the information that we need. That information comes in as the initial assessment for the suitability to form. So that's the pre-feasibility. That's the 5-year historic premium and claims data and existing insurance arrangements. If we get that information, we can work out if we can put this together. It's a great idea to have a DMF, but if the facts don't support it, then you wouldn't enter into it. But if the facts support it, then you would be worthwhile supporting. So there's a feasibility document with financial analysis that will be submitted back to the members of the RWTA. And if that feasibility is agreed that we should proceed further, then there would be reinsurance arrangements would be requested, quotes would be provided. Then you've got to go through the legal formation, structure and strategy for claims, management and processes would be developed. And then you would, if the members agree, prepared to contribute, you'd form the mutual, and then you've got all the legal documentation around that. Now, normally for all of that work, a fee is charged by Steadfast, and that was what was originally talked about being $50,000 to run that process. And I've had discussions with them, and there may be a way that we can, rather than get that up front, that we can potentially pay that over a period of time. But that's yet to be confirmed, because we would need to get further support from the industry as to whether we do want to set up a DMF. So that's a brief overview of the DMF. I'm happy to take any questions now that you might have.
That was a great overview. Thank you very much. Are there any questions that anyone has before I start?
Yeah, sorry, Paul, I was late joining. I just got held up doing something else. But what sort of scale do we need for this? You know, is it number of members, or is it the insured value, cubic capacity? What is it that we need to make it work?
Great question, Greg. Typically, they work on numbers of people who want to participate and the premium pool. I know there are some large players, and if we just had the two major players in the industry, then that would be pretty lumpy because they'd be carrying all the risk between them, and that's not going to work. So we need big and small participants in the industry to be members. It's based on premium pool and the risk exposure and the number of people. So I'm sorry, I can't give you an exact number, but that's the that's sort of the background to it.
Greg, something else that's worthy of mentioning is that quite a few people were interested in coming along today, but they couldn't. You know, time was bad for them, or they're overseas, or they pulled out yesterday and said, "Please send us the video," which we will do. So that's the idea of videoing this today.
Yeah, good. No, my apologies. I just got it.
No problem.
And Paul is Dean here.
Yeah,
Were you saying one of the purposes was to drive down claims? Was that to drive?
Yeah, exactly. The intention, so there are two purposes. One is to drive down the cost of insurance, and the second one is to make everybody's business safer. And if you make it safer from a risk perspective, then you're driving down claims.
And how are you going to do that? Through the mutual?
Because every business is assessed by a risk management team who'll go out and they'll provide a report to each business so that they understand how their business fares by comparison to the industry average, and what are the gaps in what they're doing, what are the problems in what they're doing, or what are the good things they're doing right. And it could be anything from, and this is something I mentioned out at the national conference, if people have got EPS paneling, which is highly combustible, as we all know, and a high risk to insurance, then it's possible to treat those panels with a fire retardant paint. And it could be as simple as just getting somebody to use this paint to reduce that fire risk. It could be something like that. Or they might have, a business mightn't have an annual assessment of its switchboards. Switchboards are the most likely place that fires start, and you can do thermal scanning on a 6 or 12 month rotation to assess the performance of the switchboard if there are any hotspots. People mightn't be doing that, and it could be the implementation of that rotation which drives down the potential of fire claims starting there. Or it could be the way they manage their forklifts and where they charge them if they're electrical, or if it's petrol, and where they store the fuel. So there are many different ways that could be reviewed. Collectively, we might be able to work with a fire protection industry. My business happens to insure the Fire Protection Association of Australia, and we work very closely with them, and we have access to all their members, and there might be a way for us to set up a structure if somebody wants to put through a fire protection sprinkler system through parts or all of their building. They may have got expensive quotes elsewhere, but working through us, they might find something that meets their budget, or it could be staged. There are just different ways that we can work with the members to reduce the possibility of having a bad incident.
I'm just going to ask you a question on this one,
Yeah.
because what I understand is that in the past we've had members that have been told, you know, go and get a sprinkler system, which is arguable anyway in a freezer situation. And the next year their insurance goes up again after spending $1 million. I think we need to make sure that whatever is put in place does lessen, number one, the risk. It's all about safety, but also the price.
Yeah,
prior
so,
to
and it's a
putting it
great
in.
question that or the comment you've made, Marianne. So the difference between the mutual is it's a homogenous entity on its own. It's not part of a collection of policies that cover a huge insurance company. Because what happens at a large insurance company is if they have a bad experience in a portfolio, and we use the term portfolio, let's say they've got a lot of home and contents policies and there are bushfires or there's a cyclone or whatever it might be, and they suffer terrible losses, they try to recover money across all their policyholders, even if you haven't had a claim in that event. So what will happen is, even though somebody might, as you've suggested, install a fire protection system, their premium still goes up because of what might have happened in other parts of the insurance company that they're being insured through. No fault of their own, nothing to do with them. But when it comes to the DMF, it's only operating inside the boundaries of the members that it insures. And it will only pay out to the total value of its contribution, less the expenses to run the mutual. And if claims exceed that, then that's where the reinsurance, the excess of loss insurance, comes in to protect the members and their contributions. So I'll give you an example. Let's say that 10% of the contribution to the DMF is the amount that pays for the excess of loss, the reinsurance on the DMF. In the event that there were claims that exceeded the contribution pool and the reinsurance cost went from 10% to 20%, so it doubled the cost of the reinsurance, that's only effectively a 10% increase on the contribution that the member will pay. But that's in the unlikely event that claims exceed the contribution pool. If the claims don't exceed the contribution pool, then there is no increase in the contribution that the member needs to make, because nothing has affected the operation of the DMF. Does that make sense? Different to an insurance policy, an insurance company that is managing claims that are happening, whether it's cyber insurance, directors and officers insurance, property insurance, liability, workers' compensation, doesn't matter what it is. Insurance companies are affected by all these things. They're managing claims all the time. But if the DMF is stable, then contributions stay stable. Even if there are claims that exceed, then there may be a marginal increase. It might be 5%, it might be 10%, but it's never going to be double. It's never going to be 50%. But if if claims don't exceed the contribution pool, then the members' funds are held over to potentially pay future claims to put that buffer against the excess of loss insurance that's been bought. So it's a unique, homogenous unit that's not affected by other things outside.
Okay, thank you for that. And are there some other questions from the floor?
Paul, it's just Dean again. I was just wondering about what could be the worst case scenario for the mutual? Let's say we all go in it. Yep. And then what could be the worst case scenario for all of us if something, I don't know, if one of the major players, happened to have it, I don't know. What could happen if it was, is there something that, the worst case scenario?
The worst case scenario is that everybody, it's a great question, Dean. And just talking from the hip, I'm just going to say, without huge consideration, my answer is the worst thing that could happen is you had everybody join and then 2 years later people pull out and the premium pool drops and therefore the cost for the remaining members goes up. That would be one of the worst. If you're thinking about claims, I'll say that the great thing about the industry is that you're not all cold storage sitting in one business park together, so that if there's a fire in one cold storage, it's going to take out everybody else. The cold storage buildings are across Australia, and therefore if one goes up, not all are going to go up. So if one goes up, it's contained to that environment. And in the unlikely event that that exceeded the contribution pool, well, then the excess of loss insurance protects you. So whilst not great, it still protects you and the members for, their contributions for future years.
Yeah.
But I come back to the question you asked earlier. It's about risk management. The importance of the DMF is to help each member have a lower risk profile by being a member. You don't really get that from insurance companies. They talk, good talk, but they don't implement. It's not in their vested interests like it is the DMF. The DMF doesn't want you to have a claim. They want to work with you to reduce the possibility of claims so that you can just carry on doing the business that you make money out of. The last thing you want is to have a major event.
Dean, I just comment in relation to that first question you had as far as the risk. Just to disclose, we as a business do use Paul's company to look after our insurance interests. And it wasn't long into the relationship where I forget who it was, Paul, but we had an assessment done on site as Paul described, and it was quite interesting looking at the results of that. And I can share one with you that was talked about was our cooling tower. We only have the one cooling tower. There's a provision there for another one. But one of the things that was raised was that if there was a fire in one of the fans and that cooling tower went out, what would we do? And I'm not sure what we'd do, to be honest with you, because once the cooling tower goes out, we're stuffed, But, when we were talking to the refrigeration engineers, we said, well, should we have a sprinkler system on top of these, on top of these fans to, at least protect that asset? Because if the fans go out, we might lose a week and we can put a spare, put another fan in. And they all were astounded that we'd even asked the question, but at least we were challenged to consider the risk. And, it's probably something that we still haven't done anything about, mind you, but it's something that we should consider because it probably would reduce our risk and potentially at the moment may well contribute to a slight reduction in the premium if we were able to demonstrate we've done that.
Yep.
So useful exercise, I think it's really good.
Thanks, Greg.
Are there any other questions? If not, I think, Paul, what we might do is we might bring a close to this particular meeting because this is really the first of several. This is just gleaning interest and asking some questions. So I'll get this out to the rest of the membership and make sure that, we give updates and we'll keep on with this. So, so for the people in the room, is November a reasonable time to ask you to come to another meeting, or is that going to be too close to Christmas?
Yeah,
it's good.
Fine.
Good for me.
Yep. Fine.
That works.
Yeah, cool. All right. Look, thank you so much, everyone, for attending today. There were more people that wanted to come along, but they just they couldn't make it, and they're overseas and what have you. So thank you, Paul, for that presentation. That's a really good opening to start the ball rolling. And everybody have a great day.
Thanks. You too.
Thank you.
Bye.